Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, the man himself, the smartest guy in the room. Well, maybe the second smartest guy in the room next to James Eng, Mr. Michael Becker. Michael, how are you?
Oh, yeah, doing a little tired. So, had a week in Orlando, which sounds like a long time. A couple of days with the family at the Universal Parks, and then 4 days or so of the NMHC conference. So it was a whirlwind.
It was, and we'll talk a little bit more about the conference itself. And James, how are you?
Good. Thank you for having me. Glad to be live here.
That's right. Fantastic. So we're going into the end of January of 2022. And around this period of time, there's a large conference that takes place, and it's an annual conference. And Michael indicated a little bit that he brought his family from Dallas down to Orlando to go to the Disneyland and Universal Studios. But the big thing that he went to is the 2022 National Multifamily Housing Council meeting in Orlando. And it's better known as NMHC. And it's the place where apartment industry leaders come together to guide the future success. So the big thing about apartments is that the rental housing is a huge industry. It supplies about 1/3 of the nation. It supports 17.5 million jobs and generates over $3.4 trillion to the economy. So let me set the scene of where we were last week or this week. This conference is an annual event, and it's really for apartment real estate professionals. It's not for first-time apartment buyers or syndicators, and you have to belong to NMHC to attend the event. It takes place at two hotels, the Hilton and the Waldorf Astoria, and you'll see a bunch of guys walking around in blue sport coats or suits and women with these sharp suits. It's casual, but it's very professional looking, and it was between Monday, January 17th to Thursday, January 20th, but most of the activity happens between Tuesday to Wednesday, where most of the meetings takes place, and it's pretty much a huge networking activity. So if you own a bunch of apartments in Birmingham, Alabama, and you want to diversify into Phoenix, well, you can jump on an airplane, go to Phoenix, and hopefully you'll have 5 or 6 meetings with the Phoenix brokers if they're in town and willing to meet with you. Or you can go to NMHC and schedule an appointment for 20 to 30 minutes and get, because that's where everybody's going to be, and get a general overview of the market from each broker company and see what their immediate inventory is available. So it's a little bit like speed dating. So they have about 7,000. I mean, you guys tell me, 7,000.
It's probably, I think last time I was there, it was about 10,000, maybe a little bit more. It seemed about a quarter off, maybe 30% off of normal attendance just for the COVID stuff going on.
Yeah, so I'd say about 7,000 folks from all over the country attend, and this is not a small conference. So it's buyers of apartments, it's sellers of apartments, it's apartment brokers, it's apartment developers with their construction teams, it's lenders like Fannie Mae and Freddie Mac and the bridge lenders, it's equity providers, it's economists, it's everybody that's associated with apartment industry.
Like ownership, the transactional side. It's not property management company, that's more NAA.
That's correct. That's it. So we just came back from this conference, and today what we'd like to do is kind of give you just a general overview of our thoughts and feelings. It's still pretty much baked in our heads because we just got off the jet less than 24 hours ago, and a lot of people look to us to kind of give them just kind of an insight, our information about we thought, and let's kind of discuss about our attending that conference. So, Michael, I'm going to kind of take it go to you, and what's your initial takeaway from the conference?
It was good to be back and see everyone. And like you said, I didn't go last year. They had it, but they moved it from January to June, I think it was, and they did it in San Diego. And I think there was maybe 2,000 people went to that last year. So this is kind of I skipped it. So my first one in a couple of years, that's kind of more the same in a lot of ways. Everyone's kind of right back at it. No, it's good to see everybody. It's good to, like, as Paul mentioned, as you kind of graduate up, especially if you're looking to be in multiple markets, this is an event that I think is great. It's good to, it's funny to have, Paul didn't mention, is they have this whole educational platform of these economists and panels, and everyone talks about kind of what's going on in the market and what they predict for 2022 and have these organized sessions. And I've never attended a single one. I've been going for many years, and everyone I know, no one ever goes to any of the conferences. It's all a networking thing. It's all about seeing, like Paul said, either equity providers, lenders, brokers. That's kind of really what I'm searching for, is trying to find the deal. So that's really it. It's real informal. You're kind of just walking the halls. I tried to keep my schedule relatively light, had maybe 4 or 5 meetings a day. Brokers that do it, I mean, shoot, they'll have Paul, every half an hour, on a half an hour, they'll have a meeting. So they're hustling. It's like you said, speed dating. So that's kind of to clean up, reset the scene. That's really it. So if you're aspiring growing up, it's a thing to go do and see for sure. It's pretty cool. And then, for me, it's more about just kind of it's a good opportunity to build rapport with a lot of the players in the marketplace, whether it's an equity partner, a lender, or a broker. And they do these events on Tuesday night. All the big broker shops put together these parties. A bunch of different dinners are kind of thrown, from title companies to banks or whatever. So you go there and they invite a bunch of other clients. That's really where kind of the heart of the conversation comes from. So long-winded to say, to kind of clean that up. But I think the general sentiment is there's a lot of money and there's not that many active deals on the market right now. Seems like the fourth quarter or fourth quarter of 2021, there was a tremendous amount of volume. I was busier in December than I've ever been in the year. And everyone I talked to in December had just a ton of activity going on. Everyone's trying to close something. It was really hard to get stuff done in December because everyone was stretched then. I think that's kind of setting the stage to going into where we sit today. There is a material lower amount of active inventory on the market as we speak today. Seems like stuff might be kind of cutting loose here in a month or two, because all those transactions that probably would have been out in Q1 22, a good percentage of those got brought forward into 2021. And there's even more money probably than what was there, this time last year. So I think you're going to see a lot of money chasing less deals. Should be supportive of pricing. I don't know if it gets to the point where it's like a short squeeze on GameStop stock or something like that, where the price kind of keeps going up, to use that analogy. But specifically in Class A in Texas, there's very little inventory. Cover Houston, so I don't know that as well. But Dallas-Fort Worth has a little bit more. There's basically nothing in Austin or San Antonio of any sort of size or scale, just a handful of deals in Class A, and everyone wants to be there, and the pricing is going to go higher. That's the short version.
Yeah. So a bunch of, not a lot of red flashing stop signs. Everything is turned green. So you go to the corner, and that car on the right side has a green light too. You have a green light. So I would imagine we're going to see a couple crashes, because everybody wants to buy. Nobody wants to sell. Everybody wants to. It doesn't make a difference if it's A, B, or C. Everybody is a buyer in this market. So, James, you attended the conference. What was your takeaway?
Yeah, I mean, the first day we really just walked around and probably saw 100 people in the first hour that we had known, or they had seen us or heard us on the podcast or YouTube or wherever on social media. And it was good to actually meet some of those folks in person. And even if the people who maybe live in Dallas that we know, you might see them on tours and things like that, and you might do a lunch or dinner with them. Everyone's just sort of there for 2 days. There's nowhere to go. It's sort of like everyone's forced to be in the same spot at the same time. I felt like the conversations were a little bit more relaxed. Whether you were by the pool or hitting golf balls, everybody had a good time. And I would say what changed the dynamic really was the beginning of, let's say, 2021, when bridge lenders really started opening the floodgates a little bit, where there maybe was 1 or 2 bridge lenders. And then all of a sudden, January 2021, there was like 15 all of a sudden. I think that's going to continue. That is what is a little bit driving these prices, because Fannie and Freddie were there, but nobody was really talking about my next acquisition. I'm going to do a Fannie Freddie and get 75%. It was, I'm going to do a bridge loan and I'm going to get 80% loan to cost on these deals. That works, but we're going to start seeing, I think, some of these bridge lenders push back, some of these appraisers potentially push back a little bit on some of this pricing. And so that might be the only thing that slows this down is the listing broker on a Class A deal in Dallas. It was $250 a door. Now it's $300. Now it's $350, $400 a door, but they don't have any comps. Where's the comps? Has anything traded at this price point? And are these lenders who securitize all these bridge loans going to get the appraisal there? Are they going to get the cash flows there? Right now, everyone's still 75, 80% loan to cost right now on these bridge loans.
Yeah, amazing. We'll come back to that in a second. Michael, are you seeing any upcoming concerns of the market? Was there anything that was, besides all the people that were hugely positive, did you hear any cracks or anything that you felt that could be a problem?
I think you told me, Paul, you talked, maybe you could tell what you heard from John Griggs, buddy John Griggs, about the deal he's building in Florida about construction costs. That seems like that's a real problem right now. What did you say, Paul? You said that over the last 8 weeks, the project went up 8%.
Yeah, he's building 2 projects, and 8 plus 8 is that he built one project, or he got it cost assessed of what it was going to cost him to get this project. And this is a Class A building, and it was, let's say it was X. And then he had another project that he was teeing up down the street, not too far away from the same group. And they went out to all their suppliers, and it became X plus 8% of the deal. And it was only 8 weeks difference between the first one and the second one. So it is the cost of materials that has gone up huge to some of these markets.
And so that bleeds to the value add play, right? So if you got to go buy 100 appliance packages for your units as you're turning them over, and 100 countertops and whatever else, that's up, right? And it's going to keep going up. So I think it's going to ever escalate your renovation costs as you're doing that. So that's a potential headwind. I think the other thing is, I think really we go until the money turns off. That's been my experience. So whenever the lenders get spooked and the money gets turned off, that's when the shit hits the fan, basically.
That's
Until
right.
then, it's going to keep going.
And we'll talk about that in a second here. How about one of the things I didn't hear anything being said is interest rates going up. Michael, what's your take on that?
Not a person, right? And that's been all the headlines everywhere you go. And not a single person I talked to said anything about interest rates as far as what they're concerned about. So everyone's super bullish, and I don't know if we're all just living on this high, that this bubble, it's a bubble, and we're living on a high, and it's fantasy land right now. We just can't see it, but no one said a word about interest rates.
Talking about Fantasyland, we were in Disneyland, so maybe that is an appropriate analogy to what we're seeing.
And I talked to a couple of people from a couple of different markets, and it seems like this is, generally speaking, a national thing. Pricing's moving, rents still continuing to move. Supply seems like they should deliver a record amount of supply, I think, in 2022. But it seems like, I'm looking, at least, Dallas-Fort Worth is down, San Antonio's down, Austin's up. I think Houston's pretty moderate. So, most of the listener base that a lot of people play in Texas. So it seems like all these places there, but everyone wants to be in Austin. No one wants to sell in Austin. So Austin seems like it's going to have, a very robust amount of capital coming at it. So I don't necessarily see values backing up, and it's absorbing pretty well. So there really wasn't a whole lot of people with bearish sentiment. Everyone there, maybe it's a self-selected crowd. People that go in the middle of COVID, don't care about it, fly to Florida, don't wear a mask, walk around with the 7,000 of your friends and go drink every night. Everyone there is very bullish. They drive the capital, they drive the debt, they drive the equity. Every lender I talk to needs to get the money out. So I think we have, at least in the near to somewhat intermediate term, we're going to see higher prices.
James,
what do you think about? Yeah, interest rates, I think everyone thinks at least 1 to 2 hikes this year, and then figure it out from there, I think, and see what it does to I think the I word switch from interest rates to inflation, really. Everyone's focusing on inflation and what that's going to do. But nobody seemed concerned. The biggest concern is that all these bridge loans are tied to SOFR or LIBOR. So if the Fed cranks it, let's say 25 basis points and another 50 basis points, and then I think by the end of the year, it's supposed to be 1%. So if all of a sudden your bridge loan is 3.5, your spread is 3.5, and it goes from 10 basis points up to 1%, all of a sudden you're at 4.5. And that's mighty close to where most of these deals are trading on the cap rate side. That's what you have to watch out for. I think on the interest rate side, 10-year treasury popped up a little bit. So the only saving grace is for all the guys with prepayment penalties tied to 10-year treasury. They feel a little bit better today than they did, let's say, a month ago.
Michael, anything more to add to that?
No, yeah, I think that maybe that comes and pricks a little bit of air out of the bubble if rates really do actually run. I'm in the camp that they can't run, so I'm not losing too much sleep over it. But that is certainly something that that would have an impact. Because we were underwriting a deal that I got this week when I was out in Orlando, put a floating rate loan on it. We went to go look at kind of the forward SOFR curve, and year one interest rate might be 2.5%, and then by year two, if you kind of take the forward SOFR curve, then it's the forward SOFR curve's anticipating higher SOFR in 23 than 22 and higher in 24. So it kind of limits a little bit of kind of the year three, year four, year five cash flow, where you look at all these other models we've done for the last decade. Year one is a low cash on cash, and year 5 or 6 is high, 4 or 5 is higher than year one, where that anticipation of higher debt service in the future with higher, if you float your rate, that's a little different. It's going to have some level of impact. So I think between that, increasing input costs if you are going to do a value add or build, and ever increasing demand driving cap rates lower, I think the yields are going to come in. I think that's so. If you're expecting 8% average cash on cash, that's what you got in 2021. You might need to think 6.5 or 7, because I think yields are gonna compress. Have to, just kind of mass. So I think we're gonna be paying out less money on a percentage basis than we have, and investors are gonna have to get on board with that, or we aren't gonna be doing deals, or we'll be lying to ourselves. One of those three things, I think.
Mike, what do you think about in terms of interest rate cap? A lot of times Fannie and Freddie might have you go out and buy a 3-year cap, and it might be 1.5 to 2% strikes. Bridge lenders, they seem to have a little bit more flexibility. They might buy a 2-year cap, and then it might be 1% or something like that. What are you thinking on interest rate caps right now in terms of term, in terms of strikes?
We did a deal in December where we got a waiver to get 2-year cap, and the 3-year cap was a big loan.
Double.
So call it $400,000. A 2-year cap was $150,000. So we're like, well, we'll just put that $250,000 in the bank and friggin' deal with it in 2 years. Because I think whatever it is, it's going to be wrong. I think the market always gets ahead of itself a little bit, at least in my lifetime, my official lifetime. So I think we get a couple of hikes in, and let's see what actually happens. And we start, slowing the economy down, GDP slows down. Maybe the supply chains open up. This temporary, inflation maybe is a little bit more transitory than we're all thinking right at this moment, and things kind of come back together. I don't think they run away. So we're going to take a little bit more rate risk by buying a little bit shorter cap and save $250,000, and then I'll have that $250,000 to solve my future problems in 25 months from now.
So,
but I reserve the right to be completely wrong. So we'll see how it goes.
So under that same theme about being completely wrong, and I've done this business for a long period of time, and I have been completely wrong, that people had listened to me for the last 3 or 4 years, they would be a lot poorer than the people who did not listen to me that are a lot richer. But I can be wrong a lot of times. I only have to be right one time, and that's a concern. So, one of the things that, and James has heard me say this, one of the things that I'm concerned about with is back, 10, 12 years ago when we had the single family subprime business, that the people that were buying those mortgages really didn't understand what they were buying. And then it almost became too late when they figured out that American real estate doesn't always go up. Sometimes it comes down, and in some areas it came down by 41% on the single family side in parts of California. I see a lot of parallels today. And so I'm a little bit worried about in the future where somebody will say, I don't know if we're going to be able to securitize this piece, because in the big picture things, a lender does not go out and put their balance sheet on the line to do these bridge loans. They usually have a warehouse line. That warehouse line is just like a home equity line of your house. They make it for, let's say, $1 billion, and they have to pay it down, and then they take a little bit more out next time. But to get that money off the warehouse line, they have to securitize it. So my feeling at some period of time, where do we feel is the securitization going to be there in the future to take these warehouse lines and pay them down so they can reuse them again? And I remember just before COVID, there was one lender that we did a lot of business with that had $1 billion on their warehouse line, and they couldn't get it off their warehouse line. And so they shut their business down, and it was down for a year or so until the capital markets opened up and they were able to get that amount of money off their books with a securitization. So I'm always afraid of in the future that the securitizations are going to be broken and we're going to see maybe the bridge lending kind of go away at some period of time or come to a stop. And then it's going to be back to Fannie Mae, Freddie Mac to do that type of stuff. And I know
that's a good thing about what we have, Paul. I think is a good point. I mean, I think if you get over levered and you need to get 80% total costs with the bridge loan and you walk it in with a 3.5 debt yield and your business plan is to be stabilized at a 7.5 or 8 debt yield year 3 kind of pro forma, when that goes away, then those deals kind of pop a little bit and you might get yourself in a little bit of trouble. But for our industry relative to say office, retail, et cetera, at least we have Fannie and Freddie throughout 2020 from March to August. I think we refinanced 3 or 4 loans and I was able to get a loan off, and they made me put up 9 months or 12 months worth of P&I payments. But, I was able to get a couple loans off where like try to finance a hotel at that time. I mean, you're smoke. So, right. So I think some things we're doing, which we've been doing for a while is, when we kind of cap out around 70 levered, I'm probably more like about 1/3 down, 2/3 debt. I think that helps. I always have a ton of cash. So I'm keeping a bunch of cash so I can pay for some stuff that pops up and buy good quality deals and have proper management in place. I think if you do those, maybe the market gets dislocated for a period of time, but the liquidity comes back and then that is it. But if you get caught yourself in got a 3-year bridge loan and you're over levered and you don't have any cash, then it can be a problem.
What do you say to those syndicators that don't want to put 1/3 down? They want to put 20% down or 15% down because
I've been seeing a couple of guys, Paul, that you look at these deals and they're promoting 22% IRR and 10% average cash on cash. And then you look at the package and you're like, how the heck is this guy doing it? Because I'm looking at stuff like this. I couldn't buy his deal because I thought he's overpaying. Looking at the deals I don't think I'm overpaying on, and I'm getting 13, 14% IRR and 5, 6, 7, 5% year 1 cash on cash. And you go look at his model, it's 75 on his bridge loan, maybe 80 on his bridge loan. You're paying 4% on that. And they strip in some pref behind it to go to 90 total on the capital stack. And that's at like 14, 8 current, 14 behind it. And then the investor puts in 10%. And this guy puts in like $100 in this deal or something. And his investors put in the other 99% or whatever. So he's got no real money in it. He's stripping fees out. So he's negative in the deal. And then, he's banking on, tremendous rent growth and value add on some like 5-year-old product or something. And kind of a tertiary location is what I'm thinking of specifically here. And I'm like, you just get one little hiccup and that thing's done. But I've been saying that for years and they just keep making money, like you said, about being wrong. So I've been wrong. So I think one day I'll be right. And unfortunately for those who put money in it, but it seems like the risk return on that's way out of whack.
James?
No, I mean, not until probably beginning of last year did we finally see the rent growth. I mean, rent growth was muted sort of 19, 20, once COVID hit, not until really last year did this rent growth just like pile on. And so I think that sort of gave a little extra gas for all these deals. Like maybe your deal was struggling from 19, 20, and then 21, you got a big pop in rents and you called the broker and you said, let's go. And so a lot of these deals came to market in the last 3 to 6 months, had been struggling for 2 years, and they might have had a 3-year bridge on it. And then now we've got some rent growth, you got a story, and that went to market. And so now it'll be interesting to see is, all right, can you really turn that rent roll all the way over to all these leases and get 15, 20% rent pops? Because your taxes are going to go up, your insurance is going to go up. And to get to that NOI that you're promised on year 3 pro forma, you're going to have to get these rents.
Yeah, we've been talking so much about these bridge loans because just on the old capital business plan, we did $1.2 billion, $3 billion in apartment loans last year. And so 80% of it probably was bridge lending. And so it's really become a large part of our business. But it's something to be aware of with some of the risks that can come along with that product.
In 2020, you guys probably did 90% agency?
Correct.
Yeah.
Let's talk about agency, James. Any takeaways for some of the people you talk with down at Orlando about agency?
Yeah, I mean, the agencies want to do a ton of business. They got, probably 10% more allocation this year than last year. And they would love to do all these deals that we're talking about, but their debt service coverage of 125, that seems to be pretty ironclad. Might go to 120 on some top market deals or preferred sponsors, but that still only gets you from 50 to 55% levered on these deals. And that just isn't going to work for a lot of these guys. And so it's going to take you maybe smaller deals. You can still do Fannie or Freddie just because the equity check isn't that heavy. But most of these deals, let's say they're 30, 40, $50 million, that extra 10, 15% that the bridge lender is going to give you is needed to complete a lot of these transactions. And then I would say probably month 18, maybe even month 12, once you're sort of out of your prepayment on these bridge loans, you start looking at Fannie or Freddie. It's about that time for a lot of these deals that went off in 2019, 2020. A lot of those guys are looking up and saying, hey, should I sell or should I refi right now? So deals that traded in 2019, 2020, we're starting to get those calls already that, hey, I need to get off of this bridge loan and move into something with a little bit longer term just in case there's another hiccup.
Yeah. Remember, bridge loans are forward looking. They're pro formas. They're what rents are going to be for next 2, 3 years, 4 years from now. And Fannie Mae looks through the rear view mirror on how the property is doing today and how it was doing 6 months ago, a year ago, 18 months ago. So that's what the disconnect is that Fannie Mae is not a bridge lender. They are a permanent lender based on current cash flow on the property. Any flexibility with Fannie and Freddie? I mean, I think I was hearing that you may get some additional flexibility that if it was affordable rents in the 60 to 80% AMI, the average median income for the area, that you're able to get some additional loan dollars, but it's nothing going to be like the bridge loans. Anything more?
I think, maybe in some of your secondary, tertiary markets, that's a way to sort of mitigate some of the risk out there is if Fannie or Freddie could do maybe 65 to 75% out there on a floater, that might give you a little bit more comfort. But I mean, this is just one deal story. Someone bought a deal, let's say 6 months ago in a tertiary market, and it went for 12 million, and now it's under contract for 18. I mean, stuff like that, where just cap rate compression, the amount of investor demand is so hot that some of these deals that traded in these secondary, tertiary markets, the cap rate's compressing faster than even in Dallas or Austin on some of these deals.
Mike, talk a little bit more about growth markets. Did you have any conversations again? You primarily do a lot of business in Texas. Did you talk to some folks or did you hear anything about what are the great growth markets coming up for 2022?
We actually are starting to think about expanding since we had a pretty good year last year, bought 4 deals in San Antonio. We thought that would take us a little longer than it did. And so we got that kind of done. So we're now, continue to expand in the 3 markets that we play in: Dallas, Austin, San Antonio. We're trying to look at more pitches, and I just don't want to do Houston. Maybe I'm missing out, but the next guy can make the dollar in Houston. I'll look somewhere else. We had this whole big study poll that we kind of did internally and looked at 8 or 9 markets, 10 markets, and kind of came down to Atlanta and kind of North Carolina. So call it Charlotte / Raleigh, Durham. As potential things that might kind of fit what we're looking to do. So we took some meetings with some of those guys out there, and the cap rates, the returns, the immigration is all very, very similar looking, which was, intentional. We're intentionally choosing those places because we wanted to kind of find some place that was like home, but not home. Very, very similar. But what I've noticed going out there is pricing is a lot higher. And then, there's really largely to do with the property taxes. So in Texas, you typically buy a deal, you're getting 90% reassessed to the purchase price times the millage rate. The millage rate's in the mid 2s, generally speaking. Varies a little bit, but like I was looking at Atlanta. So I go to Atlanta, it was purchase price times 90% times 40% times the millage rate. So the millage rate's high 1s to 2, and then you get 60% off basically, and then it's a little bit more stable going forward. So as we're seeing these, as James mentioned, seeing this tremendous rent growth, Texas, we'll be very curious to see what April looks like when we get reassessed. Tax band kind of keeps up. You notice some of these other municipalities, they don't keep up the way the taxes are. So your NOI growth has actually been a little bit better in some markets like that. And that's why I think Phoenix in particular has a system sort of similar to that. That's why Phoenix has absolutely exploded, because their NOI growth is even more tremendous, even though the rent growth might be, Phoenix's rent growth has been off the charts, but If the rent growth is the same, then NOI might grow a little quicker because the taxes don't expand at the same rate. So it's been kind of interesting seeing some nuances as you look across the markets. But generally speaking, I think what's worked will still work. So buy the Sun Belt, and I think you'll be okay. Follow the jobs, I think you'll be okay. And that's kind of what, if and when we do actually leave the state, that's kind of the type of market and the locations we'll be looking at.
Again, James, we've seen nothing but green lights, and that was kind of the theme at the Orlando meeting. Next year, it goes over to Las Vegas. So it's been going between San Diego and Orlando forever, and now it's going to go, I think, for 5 years to Las Vegas. So I think that is going to be an absolute shit show.
Oh yeah,
for a bunch
no
of
doubt.
people in Vegas.
If you guys do go to Vegas next year, don't book any meetings before probably 11 a.m. So even if you go to bed early, all the other guys are going to cancel on you. So don't do it until after lunch.
Yeah, it made me talking about that is that when you do make these appointments to talk with the brokers that are not in your market, but you're wanting to expand into another market, get on their calendar earlier than later, because if you're trying to make these appointments the day of the conference, the week before the conference, that is not going to happen because they're going to have 25 or 30 people already selected. So if you do go next year, make sure that you get your calendar filled up quickly on that. James, you had a chance to speak with Greg Willett. Greg just left RealPage as their chief economist and went over to IPA, over our friends over Marcus and Millichap, to kind of run their economic database. And anything that Greg Willett was saying that you thought was interesting, whether it was positive or negative?
No, I mean, I think he's generally positive. I mean, he's seeing the rent growth come through on all these leases. He's seeing these brokers in all these markets. I mean, Class A is just on fire. He's focused in on sort of their IPA division. The one interesting nugget that I think he was talking about that we really haven't talked about is build to rent and these single family rentals in these communities. And, they put out a piece to their, let's say, top 50 owners and operators of multifamily. And they said, hey, are you guys, raising a fund or putting equity in these deals of build to rent? And 50 out of 50 said, yes, absolutely. Whether that's in the far reaches of Dallas, Southern Oklahoma type of places, or outside of Austin, San Antonio. I mean, it really started in Phoenix, this build to rent stuff, but that might be the next piece of the puzzle here for the multifamily space. Is after COVID, everybody wants a little piece of a house, but housing prices went up just as fast. Like we haven't really talked about, but single family pricing went up just as fast as multifamily pricing. And that down payment is still that down payment. And so a lot of people just don't want to put down $50,000 or $60,000 on a $350,000 house anymore. They would rather have the flexibility, but have the comfort of a single family home. These single family rentals might be maybe the ceiling. Usually we looked at B deals and said, hey, what's the gap between my B deal rent and my Class A rent? And so maybe some of these Class A properties are now going to compare themselves to these build to rent guys and make sure they don't get too far out in front of their skis.
Speaking of that, you guys saw a lot of deals, and I haven't looked much at workforce housing, but like kind of gut check for everyone listening. What are some like the pricing per door you're kind of hearing as far as expectation? Maybe 70s, 80s, new stuff, Dallas-Fort Worth, maybe some other markets you're talking with. Is there some sort of like price or range that you kind of throw out of some of the stuff that you're hearing, and where was that, a year or two ago?
Yeah, I mean, let's say Class C deals in Dallas. I mean, they were probably 70, 80 a door. Now they're 120 a door is sort of the minimum that I'm seeing on most deals. Class C, I would say B probably jumped from 125 at the beginning of last year. Now it's 175. I mean, it's moved 30, 40 door up in less than a year.
Yeah.
And so
the Class A stuff, I mean, I think generic Class A suburban, no, two A minus probably in the 210 to 220, and A is probably 240, 260. And if you're really well located, it'll be more than that. And that's Dallas-Fort Worth, and Austin's probably at 15, 20% to whatever James just said. Yeah. Across the board.
Yeah. Again, think if somebody's not really familiar with that term, single family rental, think of if you lived in a housing development and you look to your right, look to your left, and your neighbors across the street. Think of all those homes and now are all rentals, and they were built as rentals right from the beginning. So there's a lot of like infill stuff that there's not a lot of space. So you may have 15 single family homes all put together that just come out of the ground. in these large metropolitan areas, but a lot of the groups that are building these things, because of land being so expensive in these central business areas or, suburban areas of these large towns, have to go farther out. They've got to go 15, 20, 30, 40 miles outside to find cheaper dirt to do that. And I think what they've also found is that the people that are, leasing these homes after they've been built, again, we would put, we would do a construction loan on these properties, and then we would turn those and convert those over to permanent long-term financing on the entire subdivision, on the entire community, that they find that it's almost a transition from higher class multifamily, because a lot of these people that want to own or want to be in these single families, they're family oriented. So they're usually a husband and wife, and they usually have a couple of kids, and they seem to have more disposable cash when they do something like that. So, a lot of these folks that have been priced out of houses, they didn't have the 3.5% or 4% or 5% to put down. So they're going to rent these properties and rent a nice single family home that would have beautiful appliances inside and a backyard and kids that have their own bedrooms type of stuff. It is really becoming a huge market these days, not so much in the urban or suburban areas, but more of outside of the central business areas. James, anything more to add to that?
No, I mean, it's just like the third ring, right? So, I mean, you would, think, let's say Dallas, you're going, Frisco, McKinney out here in that sort of secondary ring market, but, going out even further, right? So you're, instead of 30 minutes from downtown, you're maybe an hour from downtown, but you don't go to downtown that often. You might maybe go into work 1 or 2 days a week. The other 3 days you're at home, so you can do the drive and things like that. People just want a little bit more space, and they're going to use Zoom more than in person for a while for their job. So they're willing to drive a little bit further and get a nicer place. No one's above them, no below them, or to the side of them. And, they just open the back door and their dog runs out there. So they like it.
All right, just final words. Let's wrap this up. I'll start off with Michael again. Successful, non-successful meeting down in Orlando. What was your final takeaway?
Yeah, no, I think it was good. It's good seeing everybody. I'm a little exhausted. I got another event I got to go to tonight down in San Antonio over the weekend, so I'm a little tired, a little back to back. But no, it's just good. I'll catch up on my Z's later. Main takeaway, I don't know about 6 years from now, but 6 months from now, prices are going to be, I think, substantially higher than we're in the fourth quarter. Function of limited supply, a lot of money, I think is going right. And every day you wait, I think it's a little bit higher. That's kind of my immediate take. Ton of money, ton of liquidity. A lot of supply was kind of rotten forward in 2021. That should have been out right now. So get your knives out. It's going to be a knife fight.
James?
Yeah, I mean, I would say a couple of takeaways. I would say if you're a buyer out there, I mean, you need to figure out, all right, let's say 20, 30 deals come out here in DFW in the next couple of weeks. Figure out what deals you're going to push that extra 500 to $1 million on, because it's going to take that. And you better know the listing broker, the lender, the seller's mother. You're going to need to know everybody on that side of the table to make sure you get sort of last look on that deal. And I mean, this is an opportunity for some of the guys who maybe they struggled through COVID as a seller, and now it's time to bring the deal out. And there's a lot of liquidity out there. So maybe take some money off the table and sell some of your deals and move on, and maybe move up the quality scale from C to B and B to A, and follow in Mike's footsteps here. And then, if you're looking at development, I mean, I would say, some of the smart developers that we talked to during COVID, if we have another time like that, they tied up a lot of these deals, and they tied up land and things like that. So next time, if we've got to hunker down, maybe tie up some land and be patient. We didn't really touch on it because we don't do a ton of it, but HUD is extremely backed up. So if you think you're going to get a HUD loan done in 6 to 12 months, it's probably double that. So the HUD loans are taking a little bit longer for anyone out there. For construction, yeah. But I mean, even just let's say on a refi, 223F, things like that, they're backed up.
I think that's a great point James made. If you got a dog, you got some deal that you absolutely hate, it's probably time to run the cash register on it. You'll probably get paid more than you ever think it's worth, and you move on. So if you made a mistake on something, you're probably going to get not only bailed out, but massively profited off of it. So now would be an excellent time to cull the herd a little bit.
So for me, it was a hugely successful conference down in Orlando. Had some great relationships that we continued to make, and great opportunities to meet a lot of the buyers out there that are actually doing it. And so we shook a lot of hands, talked to a lot of people. But my biggest takeaway, my biggest success is after I came back from having 7,000 super spreaders of COVID, that I came to the house and I had a box that said COVID testing kit that my wife would put out on our doorstep. Before I walked in, I had to take that test and it came back negative. And I just took another test this morning. And so 2 days of negative testing means I don't think I picked up anything down in Orlando. So
yeah, if I don't have a COVID here in the next day or two, it's going to be an absolute miracle, to be honest with you. So there you go. Yeah, that is successful, Paul.
So again, thanks for spending some time with us. Again, we had a good time down in Orlando. We had some great takeaways. If there's anything additional you want to talk about, call James Zhang or Michael Becker in the future.
Paul, I thought real quick, it happened to be 3 times, like James mentioned. I thought it was really cool. 3 people came up to us, and I think one of the guys, but 3 of us were standing together. Some younger guy from New York came up to us, and he recognized me, I think, and then started interrupted our conversation and thanked us for the podcast. And then he didn't quite recognize you until you opened your mouth, and then he knew exactly who you were when you started speaking, and thought that was really cool. So we appreciate, when we're out in the wild, I guess, when people that hear us on the podcast come up and say hi. It's always kind of cool and makes us feel good about ourselves. And you get some actual feedback instead of just talking to a microphone and putting it out to the ether. So we appreciate the nice words when you guys do see us out and about.
No, and I mean, talking about that guy, I mean, we don't do this it's fun, but we want to see you guys take action. And I think that guy was able to take sort of the knowledge and the hustle and put it all together, and really went from, let's say, a property level guy to let's put these deals together. And so that's what we love to hear, is just sort of you guys using the knowledge to go out there and make stuff happen.
Again, we don't want to see anybody lose any money. So we're here on your side to help you do the best you can with the best knowledge. Again, James Zhang, thank you very much. Michael Becker, we certainly do appreciate it. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.